ask us to calculate. Hold on. It said your answer should include a calculation of the exchange difference on goodwill for the period from 4th January 20x6 to 30th September, which I found to be 9 months. So I was wondering, why didn't we use the exchange rate for the average rate for the 9-month period, 0.37?
Okay, fantastic. To do what? To translate what? So I'm going to answer that question with question. Use the average to translate what in this goodwill? What do you think? What do you think you should use it for? Remember, the average rate we use in 20x5 was to translate the impairment, which is something that goes to P or L in 20x5. Is that not? And I specifically told you that for an item that has movement, if that movement goes to P or L, use average rate to translate it. In 20x6, between 1st January and 30th September 20x6, is there any movement like impairment that goes to P or L? You can see we did the translation here as well. Is there any movement that goes to P or L? No. There is no impairment loss in 26. So that is why we didn't need it. So I'm writing this 15, the impairment loss. This amount of impairment will be shared between parents and NCI according to what? To their percentage holdings, right? Full stop. The parent portion goes to consolidated retained earning, while the NCI portion goes to NCI. Remember, the parent portion will go and reduce, because it's an exchange loss. Impairment loss. It will go and reduce consolidated retained earning, while the parent portion will go and reduce what is it called? It will go and reduce NCI. That is the NCI portion. Let me also insert comment here for this exchange difference, just to explain something. So I will say this amount of exchange difference will be shared between parents and NCI according to their percentage. Hello? I cannot hear you.
Your screen is gone.
Your screen.
Oh.
Your screen is gone.
Oh, so you were not seeing everything I was doing all along? Or you were seeing it just
No,
it just went off.
Just a while. Just one.
Okay. I've started sharing again. I don't know what.
We can see it.
Can you see it now?
Yes, Jeremy.
I'm not sure. Are you sure you can see it?
Yes.
Yeah, we can.
Yes, we can see.
Not yet.
But I'm not seeing it from.
I can't see it also.
I can see.
Let me. Wait. So confirm now that you can see it.
Yeah, it's back.
Okay. So
yes, I can see it.
The exchange difference will be shared between parent and NCI according to their percentage holding. But listen to this. The parent portion, where does it go to? Will the parent portion go to... you stop seeing it again, right?
No, it's still there.
No, it's on.
We're seeing it too.
Okay, you can see it fine. Because on my own second device, I can't see it anymore. Okay, so the parent portion of this exchange difference. Remember this exchange difference we passed through OCI in that year of 20X5. The parent portion does not go to retained earning. The parent portion goes to consolidated translation reserve, while the NCI portion goes to where? NCI. It goes to NCI. That is it. NCI. Okay, let me also write something regarding this 8.12. The first 25.7, that relates to 20X5, which is the year before. The year under consideration is 20X6. Now, I equally need to write something here.
Consolidated translation
Just,
reserve. Consolidated
what did you say?
reserve.
Is it not correct? Okay, it's not correct. Translation reserve. Okay. Okay. Then look at this 8.12. This exchange difference relates to the 9 months ended 30th September 20X6. You agree with me? This amount of 8.12, right? Million will be recognized in OCI as what? Translation gain on foreign subsidiary. On foreign subsidiary. It will be recognized in OCI. Would be recognized in OCI in the year ended 30th. Okay, it's 31 December. It's just that the sale occurred on 30th September. In the year ended 31 December 20X6 as what? As translation gain on foreign subsidiary. That is in the consolidated statement of profit or loss and other comprehensive income, right? Full stop. In equity, that is, what do I mean by equity? In the equities, that is statements of changes in equity, comma, only 80% of in the statement of changes in equity, only 80% of this amount will be recognized in the translation reserve, while the balance of 20% goes to what? NCI, not controlling interest. So that is that. Now let's go and look at what else are we asked to do in this question so that we can finish it up. The A3 says we should do an explanation of your calculation of goodwill. That is that goodwill that we have computed. We should do an explanation of it. And the treatment of exchange difference on goodwill in the consolidated financial statement. You do not need to discuss how the disposal will affect the exchange difference. So everything I've explained there talks to, although we've not explained goodwill, but if you are giving any explanation on goodwill here, it is about what I've said before, that IS 21 requires that goodwill should be treated as if it is an asset of the foreign subsidiary. And as such, it should be translated, it should be calculated first in that foreign currency. Then you will translate it using exchange rate at the date of acquisition as at that day. Subsequently, at the end of every reporting period, you should retranslate using closing rate. Any exchange gain or loss that arises should be recognized in where? Should be recognized in OCI as part of the total exchange difference, not in P&L but OCI. Also, if there's any impairment loss on the goodwill, that impairment loss should be translated using the average rate for the year, and the translated amount should be recognized directly in statement of P&L. So the treatment of the exchange difference are the one I've already given in those comment boxes. So I'm done with 3. The 3 has been taken care of, partly by what I said and partly by those comments that are included in the comment boxes. Like I've said, the main solution that bring all these narratives together will be sent to you. And when you read them, you will discover that the point that we are making is the same. Let's go to the B part of the question. The B part of the question says, and I read, explain why exchange differences will arise on the net assets and profit or loss of Bakelite each year, and how they will be presented within the consolidated financial statement. Wow. Wow. Explain what? Why? Why? Explain the reason exchange difference will arise and on the net assets and on profit or loss each year, and how they will be presented within the consolidated financial statement. That is an explanation. So narrative, discussion. Your answer should include a calculation of the exchange differences, which will arise on the translation of Bakelite, excluding goodwill, in the year ended 31 December 2006. So 2 things we are being asked to do here is to explain. But what explanation? Why exchange difference will arise on the opening net asset? Why exchange difference will arise on what? On the, what is it called? On profit for the year. You remember when you guys were taught in the class, for those of you in Nigeria, I gave you the full format of total exchange difference that we go to OCI. It consists of 3 components. Number 1, the goodwill, which we have calculated here. Exchange difference on goodwill. Number 2, exchange difference on opening net assets, where you will say opening net asset at last year closing rate, then you compare with opening net asset at this year closing rate. The exchange difference between the 2 forms part of the total exchange difference. Then you realize we will say profit for the year at this year closing rate. They will now say profit for the year at average rates for the year. Then again, the difference between the 2 constitutes another exchange difference. But here we are being told not to include exchange difference on goodwill. Why will exchange difference arise every year? Because every year, the profit for the year, you are translating it at average rate. But when it moves into SFP, it moves there at closing rate. because the entire assets and liabilities in the SFP is translated using closing rates. Number 2, that opening net asset, which represent net asset at the end of last year, will be retranslated at the beginning of this year. And when that retranslation is done, then it will be retranslated at the end of this year. So if last year you have used a particular exchange rate for that closing net asset, it becomes opening net asset this year. You will use the closing rate at the end of the current year. The fact that the two exchange different rates are different is another reason why there will be a difference, an exchange difference. Let's see what we are talking about. Let's do the calculation here. So I've done the narrative, the discussion, the explanation. I've done it in form of just explaining it. I will show you the calculation. I will send you the solution later. Let's look at exchange difference. What they ask us to do, exchange difference. And the exchange difference they ask us to calculate is for which period? They said on the translation of Bakelite for the year ended. So they are not asking us to do all the years before. It's only for that year ended 31 December 20x6. Exchange difference arising on Bakelite, excluding goodwill for the year ended 31 December 20x6, right? So I need to borrow this. I need to borrow this thing. So I'm going to put it here. Remember the format. We'll say opening net assets. Remember, opening net assets as award date. We are looking at the year ended 31 December 20x6. Opening net asset is at the beginning of 20x6, which is 1st January 20x6. Right? Do we have that opening net asset, or we need to work it out? Are we given the net asset in the question? Let's go back and read the question. The additional fact that was provided to us. So what I read before, did the examiner provide us with the opening net, the net asset at the beginning of the year? Can you see that in the question?
At the end of the page,
48 million.
would that be
Okay,
carrying
let me read.
amount of Bakelite?
Net asset as of 4 January 20x6. Yes. That is it.
60 million dinar.
That is it. It's no. On page 2, where you have disposal of Bakelite, they say Carby sold.
That was at acquisition date.
Hold on. Carby sold his entire equity shareholding in Bakelite on 30th September 2018.
$46 million dinar.
For 150 million. Hold on. Further details relating to the disposal as follows. You now have carrying amount of Bakelite. Is it Bakelite? How come the name changed there? Maybe this is the real name. Bakelite's net asset as of 4 January 20x6, dinar 48 million. Can you see that? That is 4 January 20x6. That is 4 January 20x6. It now gives us additional information. Bakelite loss for the year ended 30th December. You have 8 million, right? You have 8 million. Cumulative exchange gain on Bakelite on 1st January 20x6. You have 74.1 million. You have non-controlling interest in backlight on 1st January 2026, which is what? Which is 47.8 million. Okay. Okay. So it's 48 million dinars. But let me now tell you the issue. This 48 million is before taking cognizance of, there was a fair value adjustment that arose on the acquisition of this subsidiary. That has not been factored in. Remember, at the date of acquisition, we were told that the book value of the net asset was 60 million dinar. There was an upward fair value adjustment of 20 that relate to building. Can you remember? There was an upward fair value adjustment of 20 that relate to building. So in getting the net asset at the date of acquisition, what we did was we added that 20 to the 60 and we got 80. Can you remember? Can you remember here? That was how we got.
Yes, sir.
Yeah.
That was how we got this 80 here, this 80. So the same way we were given that 60 as the book value of the net asset of the subsidiary at the date of acquisition, the same way we are being given 48 as the book value of the net asset of this company as our award date as at 1st January 2026. What do you think we should do? Shouldn't we bring in the fair value adjustment and add it to it? We should do that. Because that fair value adjustment of 20 is not included there. Remember, if we were to do a net asset working note, I will say fair value adjustment 20. I will put it at reporting date. I will also put it at acquisition date. That is what I will do. That is what I'm going to do. That is what I'm going to do. Now, because that is what I'm going to do, ideally, it shows that this upward fair value adjustment should be there. It should be added to the 48. That will take us to what? 68. But remember, that upward fair value adjustment has depreciation impact. Because it's a building, it's a depreciable asset. Did the examiner not give us the useful life of that building at the date of acquisition? Check it out. He gave us
20 years.
He gave us 20 years. Okay. Between the acquisition date, which was 1st January 2012, 20x2, and the beginning of the year under consideration, which is 1st January 20x2, how many years do we have? 20x6. How many years do we have? How many years do we have?
8 years.
Is it
4
5 or 4?
years. 5
So I will say
years.
working
4 years.
is
5 years.
working one. Let's calculate our opening adjusted. I would say adjusted opening net asset of backlight at 1 January 2026, right? So I'll copy and put it here. So see what I'm doing. I will now say book value of net asset at 1 January 20x6, right? That was 48. That was 48. So I will say given. It was given to us. Then the next thing is upward fair value adjustment. Upward fair value adjustment that arose at acquisition date, which was 1 January 20x2. That is 20. So we'll now say additional depreciation. We need to take that one out for 4 years. That is for 4 years. Up to 31 December 20x5. Yes. That will be 20 dinars divided by 20 times 4. Raise your hand if you have any question. Equal minus 20 divided by 20 years. Is 20 dinars divided by 20 years times what? 4. 4 years. Then whatever you have represent what? It represent the adjusted net asset, which is 64. That is adjusted net asset at which date? At 1 January 20x6. So take note. Take note. So our adjusted opening net asset is that. The opening net asset must be the one that has been adjusted for all the fair value adjustment that arose at acquisition date and the impact of depreciation or amortization on such fair value adjustment. Olamide Ashade, please go ahead.
Yes. Good afternoon, Mr. Jamiu. Please, a quick one.
Yeah.
Because left to me, I would have assumed that 48 diners that is stated there already included the fair value adjustment, because if they're saying is the carrying amount, it means because the question actually said carrying amount. So I thought when it says carrying amount, they've already embedded the fair value adjustment from the beginning of 2020 X2. So I would have done this without putting that 20. I just want to understand why my logic is incorrect.
Okay, see, it says carrying amounts of Bakelite's net asset as of 1st January 20x6. When it says carrying amount, it means that is the amount you are seeing in the financial statement of Bakelite. Is that not what it means to you? That is, yes. When they give you the individual financial statement of Bakelite, are we together? That is the amount you are seeing there. Total asset minus total liability in the books of Bakelite, based on the SFP of Bakelite, as at that date is 48. So if you agree with me that 48 is what will be there in the SFP, individual SFP of Bakelite, the next question I will put across to you is this. The fair value adjustment of 20 that arose at the date of acquisition, both in theory and in real life, do you go to the financial statement of that subsidiary to adjust it, or you only do it as part of consolidation adjustments? Answer that question. Both in theory and in real life, do you compel the subsidiary that, see, I've got fair value adjustment of 100 on your acquisition, showing that your book value of the asset is lower than the fair value. Please take this adjustment of 20 and make sure you record it in your book. Do we do that in real life and in theory?
No, sir.
No, we don't do that. That is what we call push-down accounting. Push-down accounting will violate IFRS. You know why? You know they said the item relates to building of Bakelite. What if Bakelite is using cost model for its building? That means it's not supposed to record any revaluation gain in its books. So you cannot compel the subsidiary to record the upward fair value adjustment or downward fair value adjustment that arises on acquisition in the books of the subsidiary. You only do it as a consolidation adjustment, and you repeat it every year at every point in time that you want to prepare consolidated financial statement. Is that understood? That is what you do every year that you want to prepare consolidated financial statement. So if you now understand that it would not have been included in the books of the subsidiary from which they have given us that net asset of 48, then you should know at every point in time, you should always make that adjustment. The only thing that can make you not to make that adjustment is if the man says carrying amount of backline net asset, it now mention either by putting it in bracket that that figure already includes the adjustment. We need to go on mute. We are violating the rule. Everyone should be on mute. Everyone should be on mute. So I hope that is clear so that I can move on, right?
Oh, yes,
I
it's
hope
clear.
that is.
It's clear. Thank
Okay.
you so much.
So you're welcome. So we've got what we are looking for. So let's do the opening net assets. So I will now say opening net assets, which is 64, right? Opening net asset, I will now say that is working one, right? Working one. At what? At
Yes, closing rates.
at this year CR. TYCR means this year closing rate. This year closing rate. That is what it means. Olamide, can you please lower your hand? So, and that figure is going to be 64. What is this year closing rate? Closing rate at the end of 20 X. Oh, remember, the year end is 31 December, right? But the subsidiary was sold on 30th September. So this subsidiary ceased to exist on 30th September. If I may ask you, the rate you are supposed to use as this year closing rate, will it be 31 December when the subsidiary is no longer in existence prior to that date, or it should be 30th September?
30th September.
30th
Yeah.
September.
Because between 1st October and 31 December, that subsidiary ceased to exist. So this exchange difference should be calculated up to the date of disposal. So it should be the exchange rate as at that date. And what is that rate? What is the closing rate as at that date?
0.35, Dinah.
0.37.
0. Hey,
0.35.
closing as at that date is 0.35 or 0.37 is average. Don't make that mistake again.
Sorry. Yeah, that's
So I would say equals, I will just link it to this 64. Then I will divide it by 0.35, right? That gives me 183. Approximately, I'm sure it's approximately. Let me make the figures to be okay. Then I will now say opening. You know, we did this thing in the class, right? Net asset. The same working one, right? Working one figure. We'll say at what? Last year closing rate. You know, that is the format you were given. There is a format for this, which those who receive lecture in Nigeria have already gotten. So we say 64 divided by what was closing rate at the end of 20X5, last year closing rate. What was the closing rate then?
0.38.
0.38. Okay, all things being equal. So we link it here, we say 64 divided by 0.38, right? So I would like, so the difference between the two represent the, okay, no, that is not where I want to put the line. I want to put it immediately after. So we say this figure is it a gain or a loss? What do you think?
Is
Is it a gain or a loss?
It's a loss.
Loss.
It's a loss.
Listen, TYCR is this year closing rate, which is at the end of this year as at 30th September. Last year closing rate represent at the end of last year. Has the net asset increased or it has reduced?
It has increased.
It's a
increased.
It has increased again.
It's a gain, please. It's a gain, please. Then the next item is, we say profit for the year. Is that not what we say? Profit for the year. It's now not for the year, but for 9 months, right? We are dealing with 9 months. Is that not? Because that entity was only a subsidiary for 9 months. So we need to, were we given the profit or it was a loss? Let's check it out.
It was a loss.
Loss.
So Backlight made a loss of how much for the, it made a loss of how much?
8
8
million.
million.
For how many months? 12 months, right?
12 months.
Fantastic. But remember, it was only a subsidiary for
8
9
million.
months. Yeah. It was only a subsidiary for 9 months, right? We should only be interested in 9/12 of that figure. That is number one. Number two. Remember that additional depreciation, you know, we calculated it, it affected the net asset at the beginning of the year of that 64. What about the depreciation for 9 months in 20x6? You know, it has not been factored in. Remember the 20 million I told you would not be recorded in the books of the subsidiary? Likewise, the depreciation would not have affected that loss of 8 million given to us. So we need to work it out. That will lead us to working note 2. Working note 2. But before then, Wanlolua, I can see your hand up. Please go ahead.
Yes, sir. So I wanted to ask, instead of opening net assets at last year closing rate, why is not closing net assets?
Oh, no. Okay, listen. Closing net asset. You know, net asset is total asset minus total liabilities. Put it the other way around. Equity, which is share capital, share premium, and the reserve. Closing net asset represent opening net asset at the beginning of the year, plus profit made during the year, minus loss made during the year. Is that not? Plus profit made during the year. So remember that what is causing net asset at the beginning to change compared with the net asset at the end is the profit for the year, right? Can't you see the next thing I'm about to do is to deal with that profit separately? I want to find exchange difference with that profit separately. So because I'm going to deal with profit separately, you shouldn't be using closing net asset. You should look at the opening net asset separately because what will cause it to exist, we are dealing with it separately. I don't know whether that makes sense.
Yeah, I do. Thank you.
Let's go ahead and do working 2. like I've said, so borrowing from this, I would just say working 2. That is loss for the year, is loss. For the loss for 9 months, for 9 months, ended 30th September 20x6, right? 20x6. Okay. Okay. Having said that, okay. So I would say 9 months loss the question. So we're given 8, right? Times 9 divided by 12. So we'll say equal minus 8 times 9 divided by 12. I fix, right? I will now say depreciation, additional depreciation for what? 9 months. Remember the asset we were depreciating? The asset is 20 divided by 20, then times 9 divided by 12. So equal minus 20 divided by 20 multiplied by 9 divided by 12. That is 0.8. Approximately 6.8, which is 6.75. So it's 0.75. That is that. That is that. So I will not say profit for 9 months, to be lost for 9 months. Oh, loss for the 9 months. This figure is not dollar. You know they are in dinars. I made a mistake of putting dollar there. They are all in what? Dinars. Okay. So I come here and say loss for 9 months. At what? This year closing rate, which will be 6.75 divided by this year closing rate from what you said before is 0.3.
Average rate.
We'll first do at this year closing rate. They will now say at average rate. Remember, go and check the format that you have. Kristen, your hand is up.
The impairment loss, won't it come into this loss? The adjustment for the loss.
Impairment loss of what? Goodwill, right?
Yeah, for goodwill.
Which year did that impairment loss occur?
Oh.
Which year?
I'm not sure. I'm not checking.
It occurred in 20x5. So it's not the current year, so it doesn't affect it. Check it out. It doesn't occur in the current year, so it's not affecting what we are doing. So I would say minus 6. Okay, let me link it up. It's here already. Divided by 0.35, right? I need to put minus here. So that gave us 19.3, right? We'll now say loss for the year, which is 9-month period. Let me just say for the period. Nine months at average rate. AR. AR stands for average rate, which is minus 6.75. What is average rate for this 20x6, please? Average rate
0.37.
0.37. Yeah. Okay. 0.37. So divided by 0.37. That gives you 18.2. 18.2. So you get the difference between the two. Is it a gain or a loss? What do you think? Is it a gain or the difference? That difference is definitely a loss.
The loss.
It's a loss because it was negative at average rate, but negative at closing rate. But the closing rate negative is higher, so it's a loss of 1. The total exchange difference becomes how much? Without exchange difference on goodwill, the total exchange difference becomes. So this translation exchange loss. No, it's a gain, exchange gain for the period, that is for the 9 months. Yes, that is what we've been discussing. That is what we've been looking for. So we are done with the B part of the question. You see how we are gaining the mark? But you should know that it's not an easy thing. Should include calculation of exchange difference, which will arise on the translation of backlight, excluding goodwill. We are done. We are done with that B. Let's go to C so that we can be done with this question. We can earn our 30 marks. C1 and C2. C1 is a calculation. It's A1. Calculate the group profit or loss on the disposal of backlight. Wow. You know, you did this in group account as well. You learned how to calculate profit or loss on disposal. But we are now dealing with a foreign operation, a foreign subsidiary. 2, briefly explain how backlight should be treated and presented in the consolidated financial statement of Cabais for the year ended 31 December 20x5. S6 rather, that is 4 marks. So with this additional 7 marks, then we can end the full mark. Let's do C1. C1. Okay, what are we asked to do in C1? Group profit or loss on disposal of backlight. Group profit or loss on disposal of what? Backlight. Group profit or loss on disposal of backlight. That would be in currency dollar. That would be in currency dollar, not in dinars. Okay. Was it a full disposal or a partial disposal?
Full disposal.
Where did you see that? I need to see it myself. I need to be sure. Cabais sold his entire equity shareholding in backlight 30th September 20x6 for $150 million. So it's a full disposal. It is a full disposal. So we now say proceed, right? You know, I normally use 2 columns. I use 2 columns when I'm dealing with disposal, right? I use 2 columns. So I'm going to say what? I'm going to say proceed from disposal, which is $150 million. You know, if it were to be a partial disposal that the remaining investment constitutes ordinary investment under IFRS 9 or investment in associate or JV under S28, that remaining investment will be measured at fair value. So let me just say fair value of remaining investment, but there is no remaining investment, is 0. Nothing remains, right? Nothing remains. So that takes us to what? We will now say, what are we going to say? We are going to say total, right? The total is the summation of the 2, which is what? Which is 150. That is 150. The next thing is to say, you remember for disposal, we will say net asset. It must be the adjusted or adjusted net asset of the subsidiary. At which date? At disposal date, right? The second item is goodwill of the subsidiary. At which date? At disposal date, right? And the third item is what? NCI of the subsidiary. At which date? At disposal date. So the 3 items there will be at disposal date. Okay, let's first deal with adjusted net asset of the subsidiary. Listen and listen good. Listen and listen good. If you look at what we did, here, right? What we did in B, you are in B. You will see that in currency dinars, opening net asset is 64 dinar, right? We now say loss for the 9 months is what? Minus 6.75. What do you think the net asset is as at the disposal date? What do you think it should be at the date of disposal?
Net asset minus the loss.
It should be the 64 minus what? Minus the loss.
6.75. Yeah.
That is, if you are looking at it in that currency, it should be that amount. It should be that amount, right? It should be that amount. If you are looking at it in that currency. So translated using which rate? It is that amount. Translated using which rate? So I'm going to say 64, which is working note 1 above, plus what? Minus, it will be minus 6, minus 6.75, which is what? Working note 2. Everything will now be divided. The summation of everything will be divided by what? 0.35. Because we need to translate it at closing rate. So I will say 64 that you have here, plus this 6.75, and divided by what? divided by 0.35. So let me put the two figures in brackets. That is approximately 164. That is approximately 164. So 153.6. Then you say goodwill of the subsidiary at this disposal date. You know, we've worked that one out already. We've done that calculation before. We don't need to reinvent the wheel. We should not reinvent the wheel. So I will just take ourselves back to where? A2. That is what we calculated in A2 then. A2 was where we calculated it. We'll just go there and pick it. See, it's here. Our goodwill here, after translation, is 102.86. That is the figure. So we've got the second item. Remember, we are calculating this now in dollar. We want to determine our profit on disposal in dollar. The third item is NCI at the reporting date. NCI at the reporting date. That would be a separate working note, working three. Because we were only given NCI at the date of acquisition, but we've never calculated it at reporting. So I will say working three. Working note three, NCI of the subsidiary. At which date? At disposal date. Okay, I think I need to leave some line here. Okay. Okay, so we start with fair value of NCI. We start with fair value of NCI at the date of acquisition. Remember, we were giving fair value of NCI at the date of acquisition, right? Remember, we were given, we used it in calculating goodwill. Can someone remind me before translation? Fair value of at acquisition date. The acquisition date was 1 January 20x6. And you said it's how much? Okay, 20x2 rather. How much do you say it is?
22.
22 million.
In dinars. It's 22, yes. Then we use exchange rate as at that day. Can you remember what the exchange rate was? As at 4 January 20x x2. What was the exchange rate?
0.5.
0.5.
Yes, 0.50. So I will just go and link this place. Yes, this 22. You guys see this 22. Yes, that is it. Divided by 0.50. That should. Oh. But we are trying to calculate it. I think the examiner gave us something. Okay. The examiner gave us something. Why do we still want to go to the beginning? You know, if we go to the beginning, let me tell you the implication.
Yeah, it's true.
If you go back to the date of acquisition, you know the implication. That means exchange difference that occurs cumulatively between the date of acquisition and the reporting date. And 1st January 2006, we need to, in fact, up to 30th September 06, no, up to 1st January 2006, we need to bring NCI share of that cumulative exchange difference. Likewise, the profit or loss for each year, which has been accumulated, the returning from the acquisition day up to this day, we need to bring the NCI portion. The examiner doesn't want us to go back. You know why? Check it out. It doesn't want us to go back. It's not as at acquisition date. It will be as at 1 January 20x6. Because the man has already given us, it's a man. He has given us the exchange rate, the NCI at the beginning of the year. Can you see in the question?
$47.8 million.
Yes, yes.
In case they are talking, I'm not sure we can hear.
No, I wasn't talking. Okay. 47 point what?
47.8.
0.80. Okay. The next item is NCI share of the post-acquisition retained
Loss.
loss for the period. NCI share of the post-acquisition retained loss for the period. How much is the post-acquisition retained loss for the period? Do you know how much it is? When you translate that, how much do you call it?
6.75. The
Yes,
loss is 6.75.
After translation, how much is it? You know, we've translated it before at average rate of 0.37. So I would say NCI
18.2.
18.2.
of let me say of loss for the period. How much do you call it? Okay, you say minus 6.75 divided by 0.37, right? That will equal 18.2, right? Minus 18.2, we've translated it before, is then.
Yes.
Then we multiply it by NCI percentage. NCI percentage is 20%, right?
20%.
Okay. So we come, let me go and pick it where we have used it before. Here is this place. You see this line 37 column D. Line 37 column D, that is it, times 20%. So that gives us 3.6 in Jackie. Then we are going to say NCI share of exchange gain for the period. NCI share of what? Exchange gain for the period. Where is that coming from? Remember, we're only looking at 20x6. You know, exchange gain for the period consists of, okay, NCI's share of exchange gain for the period. That will consist of exchange gain on the opening net assets and on the profit for the year, which is this 13.4. Can you see this 13.4, column E, line 39? That figure plus exchange difference on what? On goodwill. On goodwill for the period. You know, there is also an exchange difference on goodwill for the period, where in requirement A1, Can you remember requirement 8? Sorry, 8.2. Can you see the 8.12 here? The one that I gave you that last story on, that is 8.12. The summation of the two of them gives you the total exchange difference. What do you think of this question? In the die that you are, for those who wrote this question for the first time, how do you think they will be panting? They will be panting in the class without running. That is, this figure is coming from requirement what?
It's just
coming
that
for.
you are feeling.
No, but you can still pass. You can still pass because now you are revising it, Abby. So that is requirement B above plus.
You're not writing in the right line.
No,
I guess you want to write it in working story. You should be in our working story.
Sorry, you are right. I'm not writing the right line. So I will say 13.4, right? That is in B plus 8.2. 8.12. That is A2, right? A2. So let me just marry both of them together. Okay, so we still need to multiply that figure by the NCI percentage. We still need to multiply because that is the total exchange difference. It should be shared. You have been told that it should be shared by 20%. So I will go and say, I'll go and marry them together. The 13.4 you are seeing here plus the 8.12 you are seeing here, then multiply by 20%. That should be 4 approximately. I'm sure it's not 4, it's 4.3. You can see it. So the summation of the three figures represents exchange, the NCI figure. That represents the NCI figure. It's not an absolute figure of 48.
Sorry, sir. What about the cumulative exchange gain in the question of 71.1 at the beginning of the year 2006?
We will use it, but not for NCI. You know, we don't need it for NCI. Remember the NCI, we've cut it short. We are not starting at the beginning of at the date of acquisition. We didn't start our NCI working at the date of acquisition, the way we always do it. We started at the beginning of the year. That means cumulative exchange difference from the date of acquisition up to that beginning of the year is of no use to us. I don't know whether you get my point. Because we started our NCI at the beginning of the year, as opposed to at the date of acquisition, the way we have always done it. Then the only exchange difference that we are interested in to allocate a portion to NCI is the exchange difference that arose in that period of 9 months. So we've got what we are looking for here. So I will say working 3. So I bring it here in bracket. Sorry, I bring it here in bracket. So then we already got equal sum of these 3. Sum of these 3. That is 218, but it should be in jacket. I want it to be in jacket. So it shows that what this guy has on this disposal is not a profit, it's a loss, right? It's a loss on disposal. It's a loss on disposal. But it does not stop there. Loss on disposal. 68. It does not stop there. I want you to take note of something. This is an unusual time that requires unusual work. I would like to draw your attention to something. If you remember the format of consolidated statement of P&L and OCI, if you guys can remember the format, you know the OCI section is divided into two. The OCI section is divided into two. The first one says items that will be subsequently reclassified to P&L. The second portion says items that will not be subsequently reclassified to P&L. If I may ask you, exchange gain or loss on foreign subsidiary, where does it fall under those two subcategories of OCI? Exchange difference on foreign subsidiary, where does it fall under those two subcategories?
Items that may be classified.
That will be subsequently reclassified.
Items that will be subsequently reclassified, right? Do we all agree?
Yes.
Yes. Yes. It falls under items that will be subsequently reclassified. Okay. In that case, do you know the reason it falls under items that will be subsequently reclassified to P&L? At what point will it ever be reclassified to P&L? I want somebody to tell me in case you know. Raise your hand in case you know. Raise your hand in case you know. Why do we normally put it under items that will be subsequently reclassified to P&L? Hello? I want to hear you. Nobody, okay. Juliet, go ahead.
It will be reclassified at the date of disposal of the subsidiary because when you dispose the subsidiary, you can't maintain it in your retained earnings because you've disposed of that investment. So you have to quickly put the gain into your earnings for the period, and right, yeah, something like that. Yeah.
Okay, you are right. It will be at the day that you lost control of that subsidiary, which is the date of disposal, that you will move it to P&L. But you say you cannot leave it in retained. It's not sitting in retained, it's sitting in translation reserve. Did you get that? It's sitting in the translation reserve. So you are moving it from the translation reserve to where? To P&L. Now listen, I can see two hands up. Juliet, your hand is still up. Since you have answered, you can lower your hand. Now, let me tell you this. Guys, listen and listen good. That amount, that translation that you are passing through OCI, you are accumulating it in a separate reserve called translation reserve. And we've agreed that on the day you lost control, of that foreign subsidiary, which is the date of disposal, the amount you have in that reserve should be recycled back to P&L. If what you are having in that reserve is positive, right? Is positive, you will recycle it back to P or L, and it becomes part of the gain on disposal. Take note of that. But if what you are having in that reserve is negative, you equally recycle it back to P or L, but it's like negative. It's affecting your profit on disposal negatively. So as you can see, this is the loss on disposal before considering reclassification of what? Translation reserve. Remember, this is for this purpose. We now need to do working for. What are we going to do in working note 4? We need to do translation different. If you look at, someone said, but the examiner gave us translation reserve at the beginning. Yeah, you say cumulative exchange gain on backlight at 1st January 20x6, 74.1. Do you know the reason he gave us is for this purpose? He gave us for this purpose. So at the beginning of the year is 74.1. That is cumulative. Before sharing between parent and NCI, 174.1. Remember, we have exchange difference that arose during the year, 13.4 on opening net assets and the profit for the year, and 8.12 on what? On the goodwill. We need to add those two to this 74.1 we have at the beginning so that we can have the cumulative exchange difference. We will now multiply by 80%, which is the percentage of the parent company. Whatever we have there is what we now need to reclassify from retained earning back to be part of this profit on disposal, gain on disposal. Remember the 74.1 we have or we were given in the question. It does not wear jacket, which means it's a gain. We take that 74.1 as a gain. It doesn't wear jacket. So I'm going to working for. I'm going to do working for. So we have groups.
So we can see
share
us.
of, I'm sure others can see. Maybe it's you. Others can see. I can confirm that. Group share of. Others should confirm that you can see my screen. Total exchange gain at 30th September 20x6 in the translation reserve. So we are interested in group share of total exchange gain at 30th September 20x6 that is sitting in the revaluation reserve, right? So are we saying cumulative exchange gain at 1 January 20x6? That is the one given in the question, 74.1. So it's for this purpose the man gave us that figure. We will now say exchange gain for 9 months, which is exactly the figure we use here. Let me just copy this thing here that I did here, and paste it here. Yes, that 13.4 from B and 8.12 from the other one. So let me just go and link it. 13.4, you remember, plus what? Plus the 8.12 here. You remember the 8.12 here. So that is 21.5. So you add the two of them together, it gives you 95.6. That is the cumulative exchange gain as at which date? As at 31 December. September now. We are ending it on September. 30th September 20X. That is cumulative, but the parent share is only 80%. So I will say groups / parents share. At what percentage? At 80%. So is that 95.6 times what? 80%. Yes, 76. Approximately 76 point something. Yes. 76.5. That is the amount sitting groups / parent share currently sitting in the translation reserve, right? So we will now reclassify this figure. We will reclassify this figure back to where P or L. And reclassifying it, remember, in line 61 here, I said loss on disposal before considering reclassification of translation reserve. So I will come here and say reclassifying or recycling of translation gain in translation gain from equity. We are classifying it from equity, which is 76.5, right? Then total amount that we will have there is the total amount we will have there is going to be, so I will say this is the profit on disposal after considering reclassification and recycling, same, recycling of what? Translation reserve. So that retranslation reserve does not exist again because we've recycled it. And these are the things you need to explain. These are the things you need to explain. You need to put that as part of your explanation. Remember, that is what the second part of the question is asking us to do. The C part of the question says, calculate group profit or loss on disposal of backlight, 3 marks. That 3 marks is a whole lot of things. It's a whole lot of work that you see that we've done. 2, briefly explain how backlight should be treated and presented in the consolidated statement of cabals for the year ended 31 December 20X. How should it be treated? Of course, you should recognize the asset and liability. That is what you need to do. You cannot consolidate it anymore. You have lost control, and you should recognize the asset and what? The liability. So when you recognize the assets and liabilities, how do you think it should be treated? When you recognize the assets and liabilities, how do you think it should be treated? See, let me show you the accounting entry. Although the examiner doesn't ask the accounting entry, but I want to show you. Arit, your hand is up. Please go ahead. Go ahead, Arit.
Okay, sir. So if it wasn't a full disposal, this recycling that we have done, what's the implication if it wasn't a full disposal?
If it wasn't
a full disposal. Yeah.
Okay,
fantastic.
Okay, what type of disposal do you want it to be? Is it that a disposal that results into loss of control?
Equity. Yes, loss of control. Equity.
Equity accounting, which is associate, right?
Yes, yes.
Okay, so The standard is not very explicit on that, but listen and listen good. Because if you have associate that is a foreign associate, are you going to be having translation reserve on it? The answer is yes. You will have translation reserve on associate as well. Because if you have an associate that is foreign, the same way you translate the financial statement of a subsidiary is the way you will translate the P&L and OCI and the SFP of that associate. And when you have your reserve, you will take your share of that reserve and you will put it in your OCI and you'll be accumulating it in equity. But some have argued that because you have lost control now, you are exchanging this investment for another investment. So it's changing from an associate, from a subsidiary to associate. The entire amount you have in that reserve, you should recycle it back to P&L. The same way we've recycled the 70 what? 75.6, 76.5. Recycle everything. Then going forward, it becomes an associate. Subsequent exchange difference you will be having, you will start afresh as an associate. You will start afresh. Some, on the other hand, argue that no, but you are just changing it. You just lost percentage. Assuming you have 80 before you sold 50, you are left with 30. So they believe that it is only a portion of this exchange difference you should recycle back to P&L. And if you are looking at that portion, assuming you sold 50 out of 80, they will say 80 divided by what? Sorry, 50 divided by 80 multiplied by this 76.5. That is the only amount you should recycle back to what? Back to P&L. Back to P&L. So the balance, you will leave it there because it's an associate. And even as an associate, you are still entitled to something there. So because the standard is not expressly stated, you have two different school of thoughts here. But I belong to that school of thought that the first school of thought that says no, you are exchanging that investment for another thing entirely. So you have lost control, you don't have subsidiary again, you now have an associate. You should start afresh. The entire amount that you have in that reserve should be recycled back to P&L. So the associate, you are starting on a clean slate now. I hope that is clear, Harriet.
Yes, thank you, sir. It's clear. However, if we didn't lose control, then there won't be any need for recycling. We'll just recognize our profit on disposal in P&L, right? Thank you.
You don't lose control. Let's say out of the 80%.
However, if it's a disposal that we didn't lose control, there will be no recycling to P&L. We'll just recognize only the gain on disposal, right?
Not in P&L. That is what I'm about to explain. Remember, the parent company here, Cabais, has 80%. If it had sold 10% out of 80%, how many percentage will you have left?
70.
If it has, fantastic. That means you have not lost control, right? So yes. That is what we call disposal that does not lead to change in control. Disposal that does not lead to change in control. Remember, we will not calculate profit or loss for inclusion in P&L. Have you forgotten? The requirement that we did in C1, this thing we did in C1, we will never do it in that situation. This thing I highlight here, if you don't lose control, you know we won't do this calculation. There is nothing that you are going to recognize in P&L. And there is nothing for you to recycle because it's still a subsidiary, right? But you know the consideration you receive for that 10%, I told you how it to be dealt with. I told you in the class, okay, not everybody was in that class, but Harriet, you were there. So what you were taught is compare that proceed you receive from that 10% with what? The amount by which the net asset will change. And you know that net asset, you must add goodwill to it. For those in Nigeria that attended Ivy League, there was a question we solved. They call it Lagos and Marina. Can you remember? That is exactly what we did in that question. That is a disposal that does not result into change in control. We never took anything to P or L. The difference between that proceed and that change in the net asset, and that net asset we include goodwill, you must take it to where? Equity. You take it directly to equity. You don't take it to P or L. I recall the day I told you, I mentioned that there are 4 items that will go straight to equity. They will not pass through P or L. The day I was saying it, I think somebody didn't follow. I said it that day and I repeated it. I want to repeat it now in case you are there in the class. Somebody has asked me, but I didn't have time to respond. I said there are 4 items that go straight to equity. They do not pass through P or L. They do not pass through OCI. Number one, under IAS 32 financial instrument, compound financial instrument, when you separate proceeds from convertible into equity and liability, the equity component goes to where? It goes straight to equity. It doesn't pass through P or L. It doesn't pass through OCI. That is number one. Number two, in equity settled share-based payment. In equity settled share-based payment, when you are debiting P or L, the employee cost, the corresponding credit goes to where? It goes to equity, which is a reserve on its own. So in share-based payment, equity settled share-based payment, that is number two. Number three, acquisition that does not result into change in control. Remember we did it? Acquisition that does not result into change in control. When you have 70%, NCI was 30%, you bought additional 5%, that means your stake increased from 70 to 75. NCI will reduce from 30 to 25. So the amount of consideration you pay for that 5% additional purchase you made should be compared with the change in the NCI figure. There is a way we calculate the change in the NCI. So that change in the NCI should be compared with the consideration you pay for that 5%, and the difference goes to where? It goes to equity rates. That is number three, acquisition that does not result into change in control. And number last is when you have a disposal that does not result into change in control, like the one you just introduced now, when you compare the proceed from selling that 10% with what? With the change in the net asset, and that net asset will include goodwill. So that difference goes straight to equity. That is number four. Arit, I'm sure you can remember.
Yes, perfectly, sir. Thank you.
Thank you. That is the end of this question. But I want to quickly show you the accounting entry to the recognize. The examiner never says you should do it. When you lose control of a subsidiary, right? You will derecognize. You will debit cash, right? For the cash you receive, right? Debit cash. Debit cash, right? For how much? For 150 million, the proceeds, right? Then you have amount you are moving out of your OCI, right? You have a figure you are taking out of your OCI. You know it's a credit. It's sitting in your translation reserve, and you are debiting it through translation reserve to OCI. So you will debit that reserve. You will say debit OCI. So apparently you are debiting translation reserve. The examiner never required that in this question, but I'm giving you in case he requests for it. Reserves, right? With how much? With that amount that you are moving out of We are moving out of this translation reserve here, right? The third thing you do is NCI is a credit. NCI has a credit balance. You need to recognize it by debiting it. NCI. What is the value of NCI? Can you remember? We did it in working 3. We will recognize the NCI by removing it. That is 48.5. So we are removing it from the book. Then we will credit. Remember the net asset. The net asset that you are seeing here is total asset minus total liability. In column C, line 57, that adjusted net asset is a debit balance, right? Total asset minus total liability. Asset is more than liability. So you need to recognize it, credit it. You say net assets of the subsidiary. With how much? With the total amount of 163.6, right? Goodwill is there in your consolidated SFP. You need to remove it. So you will credit that one too. With how much? With 102.9, which is the figure you have there, 102.9. Then you have a profit on disposal. Your net profit on disposal is 8.5. You will credit to a profit or loss. That is the profit on disposal, right? With that 8.5, which is the net result of this figure. Let me put it in green to draw your attention to it. Yes. So let's sum up all the debits. And let's sum up all the credits. Can you see? The credits in total equals what? It equals the credit. Yes, that is how to effect the recognition of the assets and liability, the recognition of the cash, and the reclassification. Any question, any query? That is the end of that 30-mark question. It has taken time because we are doing it in together, but it won't take this time in the exam. Any question? Can we quickly do question 2, after which we can now go and review those 3 standards and solve the question there. We have question 2 here as well. You have question 2, which is where you will have professional ethics. I need somebody to help me read that question 2, which is where you will have professional ethics. Harriet, do you want to finish the unfinished job? Or you finish your own job? Okay, thank you.
Will you tell ACCA to top my mark?
I will tell them. But before you read, someone is raising a hand. Victoria, go ahead. Victoria, I can recognize your hand.
Okay, thank you. So I just wanted to ask about the last requirement of the question that says how it should be treated. And I want to confirm, should this disposal be treated as maybe a discontinued operation? Or if we write that, are we going to be penalized or is it going to be correct?
If you write that as part of your solution, right?
Yes.
Okay. Okay. Remember that a discontinued operation has a definition. According to IFRS 5, it is defined as a component of an entity which has either been sold, that is disposed, or it has not been sold, but it has been classified as a disposal group held for sale. And it represents, IFRS 5 now gives us 3 points. The first one says it represents a major line of business. The second one says, or a geographical area. So or a single coordinated plan to sell a major line of business or a geographical area. So if backlight that has been sold in this question meets the definition of being a major line of business, and you know what that means. The question is this: how many subsidiaries does this guy have? We don't know. But assuming we are told, what are they doing? What are they selling? What type of business are they into? What type of business is parent company into? And what type of business is this backlight into? If this Carbies has 4 subsidiaries, it has only sold one, which is Carbies, and the other 3 are still there. The question is, what type of business, what business line are they doing? And what business line is backlight into as well? If what backlight is doing in terms of the product it sells, it produces or sells, is different from what the other one are doing, are we together? Or if you look at it by way of geographical location, this seems to be the only subsidiary that is based in a foreign country where they are using diners. The other ones are possibly in the same country where the parent company is based. If you are able to establish that, that means if you look at it in terms of business line, you can say, and it is material. If it is material, because materiality counts. So if it is material in terms of the business line, the products and everything, the figures it is contributing to the group, then you can conclude that it's a discontinued operation and it should be treated as such. So if you add that, you are not sure, you were not provided with sufficient information here to conclude that. But if you add that point, that if it constitutes a discontinued operation, it should be treated as such. But the question is, yes, they asked us that, how should it be accounted for, right? How should it be? So you can mention that as part of question C2 that carries that format. You can mention that. I hope that is clear, right, Victoria?
Yes, thank you.
Okay. All right. Arit, you were
Required.
okay. Sorry, before you
Discuss
read. Sorry, Shreya, right? Or how do you pronounce your name?
Hello, it's Shreya. Yeah, how will we get the narrative notes?
Okay, it will be sent to that WhatsApp group that you
We are
guys
not on
are
the
in.
WhatsApp group.
Are you on the WhatsApp group?
No.
Oh. You are not on the WhatsApp group. I understand a link was sent to you guys today to join the WhatsApp group. Wow. And I'm not sure the access you have, because alternatively, if we put it in Teams, Microsoft Teams, since you have access to this link, whether you can download it there. I need to ask the admin team. They will let us know how that can be made available to you.
Yes, thank you.
You are welcome.
Required. Okay. Discuss appropriate accounting treatments which TENCO should adopt for all issues identified above and their impact upon gearing. B. The accountant has been in a position for only a few months, and the finance director has recently commented that all these accounting treatments must be made exactly as I have suggested to ensure the growth of the business and the security of all our jobs. But finance director and accountants are ACCA qualified. Both finance director and accountants are ACCA qualified accountants. Required. Discuss the ethical issues arising from the scenario, including any actions which the accountant should take to resolve these issues. Professional marks will be awarded in question 2 for the application of ethical principles. Background. Stenco is a consumer electronics company which has faced a challenging year due to increased competition. Stenco has a year-end of 30th September 2009, and the unaudited draft financial statement reports as operating loss. In addition to this, debt covenant limits based on gearing are close to being breached, and the company is approaching its overdraft limits. Cash advance from Bosteco. On 27 September 2009, Stenco's financial director asked the accountant to record a cash advance of $3 million received from a customer, Bosteco, as a reduction in trade receivables. Bosteco is solely owned by Stenco's finance director. The accountant has seen an agreement signed by both companies stating that the $3 million will be repaid to Bosteco in 4 months' time. The finance director argues that the proposed accounting treatment is acceptable because the payment has been made in advance in case Bosteco wishes to order goods in the next 4 months. However, the accountant has seen no evidence of any intent from Bosteco to place orders with Stenco. Preference shares. On 1st October 2008, the CEO and finance director each paid 20 million cash in exchange for preference shares from Stenco, which provide cumulative dividends of 7% per annum. These preference shares can either be converted into a fixed number of ordinary shares in 2 years' time or redeemed at par on the same date at the choice of the holder. The finance director suggests to the accountant that the preference shares should be classified as equity because the conversion is into a fixed number of ordinary shares on a fixed date, fixed for fixed, and conversion is certain, given the current market value of the ordinary shares. Deferred tax asset. Stenco includes a deferred tax asset in its statement of financial position based on losses incurred in the current and the previous 2 years. The finance director has asked the accountant to include the deferred tax asset in full. He has suggested this on the basis that Stenco will return to profitability once its funding issues are resolved. Thank you.
Thank you very much. So give me 1 or 2 minutes. Okay, Yes, well, welcome back. Let me share the question from my side as well, since we are not likely to use Excel to answer this part of the question. In most cases, the question 2 may not involve using calculator, as you are about to see in solving this question. I can see Moyolua hand up, followed by Juliet. I hope these hands are not old hands. Am I seeing well? Moyolua, is your hand up?
No, sir, my hand is not up.
I'm seeing Juliet's hand
Same
up
here, my
as
hand
well.
is not up.
Maybe it's, I'm sure it was up. You just down. Okay, so. Hey, please go on mute. Okay. So you can see the question, right? You can see the question. And in the question, it says, Stentco is a consumer electronics company which has faced a challenging year. And they are telling you challenging year. It has faced challenging year due to increased competition. So you know that is enough to make somebody misbehave. It's enough to make the directors misbehave. So it's better you get the facts given at the beginning of the question under the background section so that it will help you to enrich your solution when you are responding. Stentco has a year end of 30th September, and the unaudited draft financial statement reports an operating loss. So they didn't make a profit for the year, they made a loss. In addition to this, debt covenant limits based on gearing are close to being breached, which means this company has borrowed money from the bank. There is a debt covenant that is tied to gearing. Perhaps this company has been told that its gearing, if it reaches a particular level, then the loan becomes overdraft, and the company is approaching its overdraft limit. So this company has every reason to engage in inappropriate accounting practice. This company has every reason to engage in what? Inappropriate accounting practice. So the debt covenant limits based on gearings are close to being breached. That means the gearing ratio is moving close to the limit that has been set by the lender. And the company is approaching its overdraft limit. Perhaps maybe the limit of overdraft approved for the company is 100 million. And this company has already used 98 million. You can see it's approaching its limits. That background information should help us to understand the behavior of the director that they are telling us here. It says on 27 September 20X9, that is 3 days before the end of the year, right? 3 days before the end of the year. Stentco Finance Director asked the accountant to record a cash advance of 3 million received from a customer, Bolster Co., as a reduction in trade receivables, full stop. Treat it as what? As a reduction in trade receivable. Bolster Co. is solely owned by Stentco's finance director, related party. The accountant has been in an agreement. The accountant has seen an agreement signed by both companies stating that the 3 million will be repaid to Bolster in 4 months' time. Wow. The finance director argues that the proposed accounting treatment is acceptable because the payment has been made in advance in case Buster.co wishes to order goods in the next 4 months. However, the accountant has seen no evidence, has seen no evidence of any intent from Buster.co to place orders with StentCo. It's a real life problem, palaver, that you may be facing in every day of life. How do you deal with this? See, in dealing with this question, remember, if you go down, if you go back to the requirements, you have requirement A that says, discuss appropriate accounting treatment which StentCo should adopt for all issues identified above and their impact on gearing. Appropriate accounting treatment which StentCo should. So that is the accounting implication. The A part of the question is asking straightly about the accounting implication. It is the B part that is talking to ethical requirement. So I will go back up there. I will go back up there. The first thing when you are attempting a question of this nature is, number one, identify the related accounting standard being examined here. Can you guys tell me the accounting standard being examined here? If you want to talk about the accounting implication, you should know the accounting standard the examiner is trying to examine. That should be the starting point. Which accounting standard do you think the examiner is trying to examine here, please? Who knows? Who knows? I'm sure you guys can hear me, right?
IS 24 and IFRS 9.
Okay. IS 24, which is related party disclosures. IFRS 9, financial instruments. Do we all agree? Do we all agree? Yes, IS 32 is equally being examined here. IS 32 is financial instruments presentation. It is being examined. It is those three standards that are being examined here. So after identifying, the step one is to identify the relevant accounting standard. IS 24, IS 32, IFRS 9. That is the first step. The second step is which principle in each accounting standard is being examined here. Under IS 24, they are trying to examine the concept or the knowledge of identifying who a related party is. That is one. Number two, they want to identify, they are trying to examine what you need to disclose when you have been identified as a related party. That is number two. Under IFRS 9, the question is this: the cash advance from Buster.co, the finance director has instructed the accountant, rather than putting it as a separate liability, the finance director has requested the accountant to use it to offset trade receivable. So it's compelling the accountant to use it in offsetting trade receivable. Is that allowed? Offsetting is there within IS 32. IS 32 is the one that deals with offsetting financial liability against financial assets. So what is being examined in IS 32 is offsetting. That is the principle. So for IFRS 9, trade receivable is a financial asset under the scope of IFRS 9. The cash advance from Buster.co, is it a financial liability? From what we can see here, if you look at That statement I highlighted in yellow, the fourth statement, 1, 2, 3, 4. They say the accountant has seen an agreement signed by both companies that the 3 million will be repaid to Buster Co in 4 months' time. That means there is a financial liability there because there is an obligation to pay cash. If you go and look at the definition of financial liability, it says contractual obligation to pay cash. So that means the 3 million is a financial liability. We are not told expressly whether the trade receivable against which the 3 million should be offset as directed by the director, whether that trade receivable belongs to Buster, we are not told. But let us assume that it even belongs to them. Can you do that offset? It is I-32 that talks about that. So once you know the principle being examined in each standard, the next thing is recall the principle. Recall those principles. You should be able to recall them. So when you recall them, you should be able to quickly jot them down. Unfortunately, you are not using pen and paper, but I'm sure you can jot them down in that place where you are going to write your solution. This type of solution, you are not likely to use spreadsheet. You will use a notepad similar to Word. You will use a notepad similar to Word. That is where you will type. The best thing is to quickly recall the principle and note it down. Then you will now develop it. Then you will relate it. So the third step is to recall the principle. And the fourth one is to now develop your point and relate it to the scenario given in the question. The first one is identify the accounting standard. That is the first step. The second step is make sure you are able to identify the principle in the standard that is being examined. Number 3, recall the principle from wherever you store it and quickly note it down in your note pad where you are going to put your solution. Then the fourth one is then you should be able to now develop those points that you've recalled and relate them to the scenario here. If you look at Item 24, related party, from what we were told, the finance director is the single owner of that Buster Co. So it's a related party. And you need to let it be known as part of what you are writing that this guy, being a related party, the transaction there might not have even been done at arm's length. So you need to identify the type of disclosure that the standard requires. The standard says a key management personnel that controls another entity is a related party. That finance director is a key management personnel of Stent Co, but is the sole owner of the other company. So it's a clear related party under Item 24. So you need to disclose that fact in the financial statement. That fact should be disclosed. And Item 24 requires disclosure of 3 things. Aside from the relationship between parent and subsidiary, it requires disclosure of 3 things. Number 1, the transactions that took place during the year, the amount of the transaction and the nature of the transaction. Number 2, the amount you are owing to the related party, if any, should be disclosed. Number 3, the amount being owed to you by the related party, you should disclose it. The transactions and the nature of the transaction. Number 2, the amount you are owing to the related party. Number 3, the amount being owed to you by the related party. So you have to disclose this amount of 3 million you are owing to that related party, which is Buster Co. So those are the points we need to talk about under Item 24. Under Item 32, you talk about offsetting. Item 32 says financial assets should not be offset against financial liability unless two conditions are met. You remember, one, there's a legally enforceable right to offset. Legally enforceable right to offset. We cannot see anything like that in the agreement. That is what we are told. Number two, the entity intends to realize the asset, that is, collect the receivable and settle the obligation simultaneously. We cannot see anything in the agreement that talks to that. That means the right to offset has not been met, and that offsetting cannot be done. It cannot be done. Number three, when it comes to IFRS 9, there's a contractual obligation to pay cash in 4 months' time. Then if you have obligation to pay cash, financial liability should be recognized in your books, equal to that 3 million, and it should be presented under liability. Under what? Under current assets. Sorry, current liability. Why do you think the finance director is playing around with all these facts? Because the man knows that gearing, he doesn't want gearing. If the 3 million is presented separately, then when you are calculating gearing, you take both current liability and non-current liabilities. You take them together. But he doesn't want you to see this. That is why he's hiding it by offsetting it against receivable. So that is what you need to write to be able to end the format there. How simple is that? It's simple. It's simple when you have the knowledge of those accounting standards, which was the reason everybody should have, proud to now, understood all those accounting standards, right? That is that. That is that. Let's move to preference shares. What do they say about preference shares? It says on 1st October 20X8, the CEO and finance director each paid 2 million cash. Each paid 2 million cash in exchange for preference share from StentCo, which provide cumulative dividend of 7% per annum. Cumulative dividend of 7% per annum. These preference shares can either be converted into fixed number of ordinary shares in 2 years' time, or redeemed at par at the choice of who? At the choice of the holder. Those are the key statements you need. The finance director suggests to the accountant that the preference shares should be classified as what? Equity. Hey, this finance director is just doing so many things. It says this thing must be classified as what? Equity, because the conversion is into fixed number of ordinary shares on a fixed date, fixed for fixed. That is what we call fixed for fixed. And conversion is certain, given the current market value of the ordinary shares. Fantastic. Which accounting standard is being examined here? That is step 1. Which accounting standard is being examined?
IAS 24, IFRS 9 again.
Okay. Because these things were issued to both the finance director and the CEO. Okay, so you can say that the liability in question, because it's going to be it's like it will have a liability, is owed to key management personnel. So IAS 24 is at play there. I agree with you. Number 2, you mentioned which other accounting standards?
IFRS 9.
Okay, IFRS 9 will come to play after you have done split accounting.
Yes.
After you've done what? Split accounting. You know split account. But prior to doing that split accounting, or which accounting standard do you follow to even assess whether the instrument you have issued is a financial liability or is an equity instrument? Which accounting standard do you follow?
IS32.
Definitely it's IFRS 9. It's IS32 rather, IS32. So it's IS32 that should have been applied to do that separation that we're talking about. Okay, so IS32 is at play. What do you think of what the finance director is doing? You know, he has motive. The information they gave us at the beginning of the question is what is driving the finance director to misbehave. Perhaps it's a member of ACCA, that is what they said, right? And is misbehaving. That means he knows what he's doing, but is deliberately misbehaving. So, what you are now, you've identified IS32, IS34, you know the principle. The principle being examined here is the instrument you have issued, is it a financial liability or is it an equity instrument, which is a principle that IS32 deals with in detail. Then if you consider it to be a compound financial instrument, then that means you need to do split accounting to separate it. Again, IS32 deals with that. Then after separating it into equity and liability, the equity portion goes to equity. The liability portion, then you need to do amortized cost. IFRS 9 takes over from there. IFRS 9 kicks in from there. So you need to discuss it. Now you've identified the principle. You've recalled the principle. Then let us relate the principle to what we have here. When you are relating the principle, what will you be saying? You will be saying that this is what the standard requires, but this is how this thing should be treated. How it should be treated is, even its fees for fees, you remember in the definition of financial asset and financial liability, go back and check. We say a contract that may be settled in entity's own equity instrument. If it is a non-derivative instrument, it's a non-derivative instrument that may be settled in variable number of shares, other than giving fixed number of shares. And if it's a derivative instrument, it's a derivative where you are going to pay or receive variable amount of cash to issue or receive variable number of shares. That is variable for variable. So variable for variable or variable for fixed will always be taken to be a financial asset or financial liability. But if it's fixed for fixed, yes, it is an equity instrument. But this one looks like a compound financial instrument because it is, yes, they will convert into fixed number of shares, but it is at the liberty, the directors, it's at the liberty of both the CEO and the directors to decide whether they actually want to convert or not. And what you now need to do is to do a proper assessment as to whether this instrument contains equity component. You know it will contain equity component if one, it is the number of shares into which it will be converted is fixed, and which is the case, they mentioned that one here. The second one is if it is issued in the functional currency of that entity. The question is silent on that. And because the question is silent, when you are writing, you will be saying that if it is issued in the functional currency, then that means this thing contains equity component. So they should have done the separation into equity and liability. The equity portion is likely to be small, which is the right to convert. And that is the only portion that goes to equity. The balance goes to where? Liability. You know, because this man knows that the gearing level is becoming high and bank will soon recall the loans and stop them from overdrawing the account again. That is why they are trying to conceal liability by putting it as what? As equity. Okay. And you move to the third one. The third one talks to what? Deferred tax asset. Deferred tax asset. And it says StentCo includes a deferred tax asset in a statement of financial position. Remember at the beginning of the year, we have already been told that this guy, what happens to it? It says StentCo has a year end of 30th September 20X9, and the unaudited draft financial statement report an operating loss. It reports an operating, which means in the current year is a loss, right? So if it's a loss in the current year, what else do they have to tell us here? Let's listen. StentCo includes a deferred tax asset in a statement of financial position based on losses incurred in the current and the previous 2 years. Interesting. It means this company did not just make a loss in the current year. It made a loss in the prior year, the last 2 years. That is what we are being told here. The finance director has asked the accountant to include the deferred tax asset in full. Wow, interesting. In full. He has suggested this on the basis that StentCo will return to profitability once its funding issue are what? Resolved. 3 marks. So the only basis upon which the finance director is asking the accountant to recognize the deferred tax asset fully is what? Is he believes that they will soon start making profit. They will soon start making profit. No basis, no convincing basis here. Which accounting standard? Let's start from there. Step 1, which accounting standard do you think is being examined here?
IAS 12.
IAS 12.
Yes, 5, income taxes. Number 2, which principle within IAS 12 is being examined here?
Recognition of deferred tax.
Recognition of deferred tax assets.
Recognition of deferred tax asset. Fantastic. Fantastic. From what you guys learned before now, deferred tax asset could arise from how many sources?
3.
I want to learn from you guys.
3.
Sources.
3. Fantastic. Deferred tax liabilities will always arise from one source, but deferred tax asset can arise from 3 sources. What are the 3 sources?
Unused tax credit.
Unused tax credit, that is number 1.
Carried forward losses.
Carried forward unused tax losses, that is number 2.
Then deductible temporary difference.
Fantastic. Deductible temporary difference, that is number 3. So which one do they say give rise to the deferred tax asset in this question?
Carried forward losses.
Carried forward credit
loss. Fantastic. Fantastic. Now, you guys have identified the principle here. So, we've recalled the principle. That is step 3, right? Let's now relate that principle to the fact, which is what we are trying to do now. If I may ask you, what does IAS 12 say regarding deferred tax assets when a company has deferred tax asset arising from unused tax losses? What should you do?
It can only be recognized if they are certain they will make profits that will be able to cover it.
If they are certain, right?
Yeah.
If it is certain.
If it is
extent
okay, yes.
Sure.
So look at the way IAS 12 put it. It says deferred tax assets should not be recognized. It should be recognized on all deductible temporary differences to the extent that it is probable that sufficient taxable profit will be available in the future to be able to recover that deferred tax asset. Full stop. except when it arises on initial recognition of an asset or liability in a transaction that is not a business combination. And at the time of recognizing it, it does not impact on the accounting or taxable profit. After saying that, it now goes on to say that when you now have deferred tax asset arising from A, unused tax credit, B, unutilized tax losses that can be carried forward, the level of assurance you need is no longer probable. The level of assurance you need needs to go beyond what? Probable, which is the initial statement I made. It needs to go beyond probable. More importantly, if in the last few years you have been making losses, it needs to go beyond what? Probable. If in the last few years you have history or experience of making what? Losses. What do they say? The last 2 years and the current year, this company has made a loss. What does that tell us? That tells us that this company, to recognize the deferred tax asset arising from unused tax losses here, you need more than probable assurance. You need what? Convincing evidence. In quote, convincing evidence. That is what you need. Convincing evidence is what you need before the deferred tax asset can be recognized. From what we've seen here, this company does not have convincing evidence to recognize what? This deferred tax asset. So given that the company is already at the risk of hitting the overdraft limit, and there won't be any space for this company to borrow money again, given that this company is almost at the risk of hitting the gearing ratio set by the lender, which is the covenant in the law, the risk is that this company will not even have money to pursue a business that can give it sufficient profit, future profit, to be able to recover the deferred tax asset. And as such, that deferred tax asset should not even be recognized at all, not to talk of recognizing it fully. So that is what you need to be able to end the 3 months. Remember, we have 4 months, 4 months, 3 months. That is what? That is 11 marks. 11 marks. That is the accounting implication. So in dealing with this type of question, the best way to solve it is, I've told you the 4 steps. Number 1, which accounting standard is being examined? Number 2, which principle within that standard? Number 3, quickly recall that principle by noting what you can remember. Number 4, relate it to the question to do your explanation to develop those points. The B part of the question says, the accountant has been in her position for only a few months. Wow, for only a few months. Perhaps this accountant has been looking for work for years. He's been looking for work for years. Is it he or she? Is she? She just got one. Okay, before I continue, Juliet, your hand is up. Please go ahead.
Okay. I want to know, while mentioning the requirements of the standard, do we have to say it exactly the way it's stated by the IFRS, or should we say what we understood? Would it still earn us the required marks?
Okay. The way I will answer it is this. If you can remember it the way it is in the standard, you can say it that way. But you know, you are just first saying what is there in the standard. You still need to develop it further by relating it to what the scenario here. If you can remember it, why not? If I were to be in your shoe writing this exam, there are many things that are in my head. I can remember them as a result of having taught this thing over the years, and as a result of the fact that I'm applying this thing in my office. However, if you can't remember it the way it is written in the standard, please say it in your own words. The man understand. You understand. Samuel, your hand is up. Please go ahead.
Hi, Jamie. Yeah, I just wanted to get clarity on this. First, with the, I don't know if you can just throw up a little bit the first information that we were given, where they mentioned that the accountant could not find any intention of the customer making any future order. Just wanted to ask again, if there was in the first place, would that have changed anything? I mean, would it have changed the recognition of that receivable? Because you also underlined that part.
Okay. However, the accountant has seen no evidence of any intent from Buster Code to place order. Okay.
So that's one. Secondly, with the preference shares, I also wanted to confirm where there is, so at the date of initial recognition, where the entity expects that conversion is going to take place, right? Are we still going to do split accounting, or we just go and recognize in equity? And then last one, sorry. Last one is deferred tax, right? I like to think that the director is the one that actually do the projection of whether or not there will be taxable profit in the future. So if the entity's issue is that of cash flow, which seems to be the case in this case, and they're saying that if we can get the funding issue resolved, we're going to make taxable profit. Why shouldn't we recognize the deferred tax assets? Why can't we just trust, or I don't know, something along that line? Like they've made projections, and it seems that yes, if they can. Are we saying that because are we saying the reason why you cannot recognize that deferred tax asset is because we don't see that happening? Or
okay,
what?
Thank you very much. You've really asked three fundamental questions, which are very good. The first one you ask is the last statement under that cash advance from Buster, which I underline. The one that says, however, the accountant has seen no evidence of any intent from Buster. You know what the director said there is, he said, he argues that the proposed accounting treatment is acceptable because the payment has been made in advance in case Buster Co. wishes to order goods in the next 4 months. All of you listen good. If you are a seller of a product and your customer has paid in advance for goods that you will deliver to them at a future date, your customer has paid you in advance for the goods that you will deliver at a future date. Is it a financial liability in your book or not? I want you guys to answer.
It is not.
It is
not. It is not.
It is. It's a financial
It is
liability.
not. It is not. It is not. It's a contract.
It's a liability, not a
It's a
financial
contract
liability.
It is a liability.
Fantastical. It is a contract liability under IFRS 15, but not a financial liability within the scope of IFRS 9. We need to get that. Why? Financial liability, you have obligation to pay cash to somebody at a future date, or to transfer financial asset to another party at a future date. But contract liability, you have no obligation to pay cash. Are we together? You have obligation to deliver goods or services. Contract liability, you have obligation to deliver goods or services at a future date. The two of them are not the same. So if what the finance director is saying can be found in the agreement, are we together? Then that means it's not a financial liability. And it cannot even be, the issue of offsetting it against receivable does not even arise. It's not allowed because there is no accounting standard that permits contract liability to be offset against financial asset, which is trade receivable. So that offsetting issue will not arise, and the contract liability should be separately presented on the face of financial statement as a liability. And it will still form part of the liability to be used in calculating gearing. It may, depending on what they see as liability, but it's not a liability that will require outflow of cash. Rather, it will require outflow of goods or services. So it's not a financial liability. I hope that answered that question. The second question you asked is, they said they will convert into fixed number of shares. Listen and listen good. All of you listen and listen good. And whenever I say listen and listen good, please listen. There is a difference between mandatorily convertible instruments and instrument that is convertible at the option of the holder. I will say that again so that you can get it. Mandatorily convertible instrument and instrument that is convertible at the option of the holder, they are two different things. When something is convertible at the option of the holder, it means the holder can choose to convert, it can choose not to convert. Are we together? Depending on which one pays in better at the date it's supposed to convert.
It's a matter of choice. Yeah.
So for that purpose, instrument that is convertible at the option of the holder, which is exactly the type of instrument we have here. That type of instrument should be, you should apply split accounting to split it into two, provided the other two conditions are met, which is to be converted into fixed number of shares. Two, it has been issued in the functional currency of the issuer. However, mandatorily convertible instrument, all of you listening to this, what is that? What is mandatorily convertible? It means the holders don't have a choice. The holders, the investor in that instrument, they do not have a choice. They must convert at the future date. What type of instrument is that? It is 100% equity from day one. It is 100% equity from day one. It may have liability component, which will be small. If mandatorily you must pay interest or dividend. You know, in this question, they said 7% interest to be paid is cumulative, which means if you don't have enough money or you don't have profit to pay this year, you will pay it next year. So that shows that that 7% is cumulative and mandatorily it must be paid. So if they had said this instrument, converting it to equity is not at the discretion of the holders. It is mandatory for them to convert at maturity. The entire proceed will be deemed to be what? An equity instrument from day one. But the only liability portion is going to be the present value of that 7%, 7%, 7% until it is converted. It is going to be the present value of that future 7%, 7% until it is converted. That will be the liability component, and that is going to be very small. So that is the response to your second question. Your third question is on the factors. Yes, it's the finance director that prepared the forecast. Do they even tell us they prepared the forecast? Is it mentioned here? I can't see where it is mentioned that a forecast has been prepared by this guy. They said the finance that look at what they say. They said the finance director has asked the accountant to include the deferred tax asset in full. He has suggested, he's just making a suggestion without any basis. he has suggested this on the basis that StentCo will return to profitability once its funding issues are resolved. So, where is the forecast that has been prepared? Number one, no forecast is given here. And don't work based on something that is not provided. Although you can work on something that is not provided, you will say assumption. You will say clearly that on the assumption that, but let me tell you, when you prepare that forecast, what is the underlying figure? The underlying figures that you have, what support them? If you say you will make revenue of this amount, that revenue, is it based on a product that you have always sold in the past that we know very well, or a product that you are just developing that has no track record? So that is why we say we change it from the level of probable to the level of what? Convincing evidence. Convincing evidence. And I hope that answered your question. I hope that answered your question.
Yeah, thank you.
Okay, someone raised his hand or hand, but the hand disappeared again. Okay, I want to quickly read the other part. The accountant has been in a position for only a few months, and the finance director has recently commented that all these accounting treatments must be made exactly as I have suggested to ensure the growth of the business and security of what? All our jobs. Hey, both finance director and the accountants are members of ACCA. Required. Discuss the ethical issues arising from the scenario, so including any actions which the accountant should take to resolve the issues. 7 marks. You know the entire marks in this B part is 9 marks. 7 marks. It now say professional marks will be awarded in question 2 for the application of ethical principle. It's about 9 marks here. For the Ivy League students, I gave you a one-pager, a one-page document that actually talks to how to deal with professional ethics. Also on the slide that we use in the class, you have this slide that talks towards the end, that talks about the courses of action open to the person who is being threatened, which is the accountant in this case. So a member of ACCA is threatening another member of ACCA. What do you think you are expected to do? ACCA want us to act ethically. They want us to demonstrate in our place of work, in whatever we are doing, that we have the understanding of the moral principles that should govern our behavior. And we are going to act according to that ethical standard, the highest ethical standard. So it's good that the finance director here is an SSA so that you know the right thing to tell him. So the first thing you should be telling the finance director, the accountant who just got the job, is to ensure that she does the right thing. She should look at the accounting treatment. And from what we've seen, the accounting treatment being proposed by the finance director in all ramification is not the appropriate accounting treatment. In all ramification, in all these scenarios there. And what the accountant should do is, accountant should sit down with the finance director. He's knowledgeable. He should sit down with him. Perhaps he has forgotten what he learned when he was doing ACCA. Maybe it was a long time ago. So let him know that based on the relevant accounting standard, these are the way this thing should be done. She should take note of the notes, all our discussion. She should take note. I'm not saying she should record, because recording somebody without permission is unethical as well. But if the finance director says, yes, record our conversation, you can go and record it, so that at a later date, you can use it as an evidence to protect yourself as the accountant. So if you tell the accountant, the finance director, if he refuses to listen to you, the next thing is you can want to talk to the MD or the board. You may also want to bring it to the attention of the chief internal auditor, depending on his line of reporting. Ideally, if he reports to the board and the MD, you should be able to bring it to their attention. If you believe they are not still doing the right thing, you can also let the finance director know that as an ACCA member, he has the responsibility, the moral responsibility of keeping or living the ethical standards, which is something that we are learning here, and you are learning in other papers as well. So if he refuses, consider doing what? Consider reaching out to ACCA line, because both of you belong to it. Reach out to ACCA, let them call both of you. You know that we actually require courage, because the accountant who has been looking for jobs for years, that just secured one recently, should know that the moment the finance director knows that he is being summoned by ACCA for this purpose, then he knows that he's going to sack the accountant. But again, you know, the accountant needs to be careful, and likewise the finance director. You should refrain from preparing financial statement that is misleading, whether or not it will benefit you. You know, the finance director is concerned about the security of his job. So the accountant should not succumb to that cheap blackmail. If ACCA cannot help resolve the matter, you may want to consider seeking a legal advice from a lawyer, maybe within or outside. If the lawyer cannot help you as well, then the last option will be for you to consider resigning, because you should not do something that is against the highest level of standard or ethical standard that we all assigned to uphold. So that is the end of that question. If you are able to write all this, then you get the 9 marks, 20 marks cheap. This question may appear cheap, maybe because we've analyzed it together. Maybe because I'm able to recall all this. If you were alone in the exam hall, will you be able to identify the standard and be able to recall the principle? That is why what we do at Ivy League is to first teach you the principle in each standard, so that you will be able to bring them back and apply them. Professional ethics, you cannot afford to lose marks there. Those marks, you must get them fully. Okay, Nohu Alim, your hand is up. Please go ahead.
Okay, hi, Jamil.
Yes.
Okay, so from here, I don't know, I'm not sure we mentioned, okay, we actually mentioned the actions that could be taken by the accountant, which were very practical. And but talking about the issues, I was hoping we will mention maybe for me here I saw intimidation. So I saw the accountant being intimidated by the finance director here. So I don't know if it's okay to mention that in this scenario. Then also where we have the first scenario where we have cash advance from Buster Co. I also underlined where they said Buster Co is solely owned by Stern Co-finance director. I don't know. I saw a case of self-interest here. I don't know if that could also be mentioned in this case.
Okay, so the first one you mentioned, yes, it's not everything that I've mentioned. It's not everything that I've mentioned. So the point you raised, the first point excuse me, you raise can be mentioned. Yes, can be clearly mentioned. So that threat is something that needs to be mentioned. Also, part of what I didn't mention is acting ethically or upholding ethical value for the preparers of financial statements, of which the accountant and director, the finance director, play a significant role there, requires you to ensure that you comply with relevant accounting standards. So failure to comply with relevant accounting standards without any justification for departure will amount to not acting ethically. Then the second one, which is, yes, is the sole owner, but there is nothing that says there can be related party transaction. That is why you have I-37. All you need to mention is what I've identified, which is the fact that that finance director is a related party, is a key management personnel. Make sure that you're able to make that disclosure in the financial statement and disclose every other thing that is 24 asks you to disclose. And once you have done that, you are fine. You know, this is not a transaction that involves buying something or selling something. So if it involves buying or selling, the question is, have you done it at arm's length? The price at which it has been sold or the price at which you have bought it? Is it the price that will have applied to every other person? So IS-24 says if the transactions are done at arm's length, please disclose that fact in the financial statement. So that is that. Someone raises her hand as well, but I can't see that hand again. It has gone. No, I believe your answer, your question has been answered, right?
Yes, Jeremy, thank you.
Nicholas.
Yes,
Nicholas, go ahead.
Yes, I was saying I'm the one who addressed my hand, but it's the same question that Nuhu asked. So, yeah, I've been responded to. Thank you.
Okay, thank you. Kenechukwu, your hand is up. After that, Stria.
Yes, can you repeat the loss option that you said that if ever nothing has been resolved, what is the loss option that we can take?
Sorry, say that again.
Can you repeat the loss option that we can take if the conflict has not been resolved with the financial director?
Okay, thank you. I said the accountant may consider resignation. She may consider to resign. But you know, doing that requires courage. Strong courage for somebody who has been looking for work, who just got one recently. But that should be the last option to be followed. It should be the last.
Okay. Yeah, okay. Thank you.
You are welcome. Kenechukwu. Kenechukwu, unmute yourself. You are on mute. Kenechukwu, you are still on mute. Okay. Kenechukwu, perhaps then you can lower your hand in case you don't have any question again. I think we've done We are done with group, but you guys should remember that it's not all aspects of group that we've been able to. The beauty of group account is for you to solve many questions, as many questions as you can do. The question we did today that borders mainly on a foreign operation, foreign subsidiary, I think it was examined in 2019, September, December. I don't know which of the two died. You know the way CCA does.
Our mock.
Is that your mock?
Is our mock, sir?
Hey, the initial mock or the final one?
Final mock.
Ah, they will have to change that question. That can't be mock anymore. I didn't know. Unfortunately, I didn't say.
Oh, I thought it was 2018.
Is that?
I thought the question we solve now is 2018. I'm not sure, but I've seen it before. It seems like 2018 exam.
It's 2019.
Is it 2018? I can't remember.
No,
The one we just saw. The one we just saw, question 2, is 2019, September, December. I was talking of the initial one. I think the initial one is 2019, March, June. Okay. What I just want to say is, I want you guys to look for questions that deal with statement of cash flows. Try to attempt them before you go to the exam. More questions that deal with statement of cash flows. There were questions, interesting questions on statement of cash flows. But those questions were under the DEMP 2, where they will ask you to prepare full consolidated statement of cash flow from beginning to the end, and it will carry 35 marks or 30 marks. But that type of question will not come again under SBR. But if you have time, you could lay your hand on those questions. They are very interesting. They make you to master statement of cash flow. There was one in 2008, Wabot. It has something unique. There was one, I don't know whether Angel or something. So all those questions are very interesting. If you have exhausted your time with SBR question, you can still lay your hand on those ones, even though they won't ask you to prepare full statement of cash flows again. Make sure you solve more questions that border on consolidated statement of P&L and OCI. They won't ask you to do the full one. They also still solve questions on the IAS, what is it called? IAS, on the group, how to calculate maybe goodwill and some other things, disposals. Okay. There are 3 more accounting standards we are supposed to actually touch on. IFRS 15 revenue, then financial instruments, and I have a whole lot of questions for them. You must have seen them, especially under financial instrument. I have too many questions. I have up to 46 marks question there. I hope we can touch all of them. Revenue, I think we need to go on another break now, right? We've been sitting down too much. So we need to go for another break. Can we say this is 3:35 in Nigeria? Can we say another 25 minutes, right? So that we resume back by 4 p.m.
Yes, sir. Okay, sir. Thank you.
Okay.
Thank you.